So the Bank of Canada held its policy rate at 2.75. The governor, Tiff Macklem, says he does expect slowing growth for business and household spending. Let's talk to David Wolf about this. He's portfolio manager at Fidelity Investments and a former Bank of Canada advisor. David, thanks for coming in.
Thank you.
Okay, so first of all, let's talk about the pause and what you think that signals for the path forward this year for the Bank of Canada.
Right. So first of all, there was a split in the market, as you've been talking about all day, between expecting a cut and expecting no change. And those that were expecting a cut seemed to be signaling some confusion about why the bank would not change interest rates in this environment, given that the two scenarios that it laid out, one has moderate growth, but as you mentioned just earlier, inflation very much on target, and the other is a recession, and inflation goes up only a little bit. And I think there was actually some interesting information about the bank's beliefs about monetary policy in this kind of very uncertain tariffed environment, if you will. So in the two scenarios, so the good world is where tariff threats basically go away or almost go away.
Dissipate.
Exactly. Dissipate is a great word.
Great word.
So in that environment, the bank still thinks that the economy will slow a little bit, but inflation is well contained, et cetera. In the bad scenario, as you mentioned, you get a pretty significant recession. Inflation goes up to 3%, but comes right back down. Now, in both scenarios, as with every projection that the Bank of Canada puts out, there is a path of policy in the projection. They don't tell us what it is, which is something I've had an issue with the bank for 25 years, including when I was there, and haven't won that one. I think they should disclose what that path is. But anyway, there's a path in there.
Why don't they?
That's a different conversation. We could spend our few minutes on
10 minutes on that, okay.
Yeah, but you can think of it as like there are dots, like the Fed dots in there. They just don't tell us what they are. So anyway, if the good world required easier monetary policy and the bad world required easy monetary policy, then either way you go, if you think you're going to cut, you would have cut today. So what that tells us is the bank doesn't actually think that there's much, if any, easing that needs to be done regardless of the outcome.
Interesting. Okay, I also want to talk to you about the trade war and sort of the effects on Canada. You have said that Canada looks like, I want to get this right, bad house in a good neighborhood initially, and now it is a house next to a sketchy park. What made you change that comparison to make it that sort of step over?
Right. So we did write that in a piece about a month ago. And let me sort of step back and talk more broadly about how we view the U.S. From our, I'm part of Fidelity Canada. So we are Canadians managing money for Canadians, even though we have, as you know, a U.S. parent. And so our perspective, and I think most of the market's perspective, as of, say, January, was that basically things were never going to go wrong for the U.S., right? Valuations were high, growth was going to go on as far as the eye could see. The new administration was going to reignite animal spirits, cut taxes, deregulate, all of these really wonderful things, and markets were priced that way. And what we've gotten is obviously something very
Twists
different.
Twists and turns and uncertainty.
Right. And so in that context, we've become a lot more concerned about the global economy and a lot more concerned about equity risk. So we did a lot of reduction in our equity holdings in the first quarter of the year. Okay. But I think above all, we're concerned about the U.S. itself, right? So you have this juxtaposition of still relatively high valuations in the U.S. They've come down. They're coming down more today, but they're still quite a bit higher than equity valuations in the rest of the world. Same with the U.S. dollar. It's come down a lot. But if you want to get back to just a historical average valuation, it still has further down to go. So one of the core pieces of our investment strategy in the first quarter of this year, and I can't really speak to the current, we don't, we disclose with a lag, so to speak. But in the first quarter, as we wrote about a month ago, much of what we've been doing is reducing our risk profile, reducing our U.S. dollar assets and deploying them in various other, what we think are less risky areas.
Okay, so where does Canada fall in that, right? How do you view Canadian equities at this point? Because, again, the sketchy neighbor is still the sketchy neighbor, right?
Yeah, and hopefully it doesn't get more sketchy,
exactly.
Right? And that's a serious concern. So there are a couple of ways to think about it. So if you think the U.S. is going down, right, from a market point of view, naturally you'd expect other stuff to go up against the U.S., right? on a relative basis. That's just math, right? And so, that's obvious. It's Japan, it's Europe, what have you. So Canada is not U.S., and we all want to keep it that way.
But so tied to.
But so tied to the U.S. So if you look historically at what happens when the U.S. dollar, for example, is going down broadly, the Canadian dollar tends to appreciate with other currencies against the U.S. dollar. Not as much as other currencies, but it tends to go up. And we've seen some of that in the past several weeks. Most of the time, but not all of the time. Sometimes the Canadian dollar can actually act as what we would call a high beta U.S. dollar. It's the sort of the old adage about the U.S. sneezes, Canada catches cold. We have such leverage to the U.S. economy. It takes 20% of our exports. You just can't fill that gap the way that the Europeans or the Japanese, the Chinese, what have you, might be able to. So one of the things we've been debating is where Canada fits in this world. And one thing, so my responsibility, among other things, is the active asset allocation on the funds that I'm responsible for. It's about a $100 billion book of business here in Canada. So it's pretty big assets. We can't move them particularly fast, but we try to take high conviction active positions, and a high conviction active position has been reduce U.S. exposure, increase European equity, tips, gold, and domestic bond exposure, which we've done. The Canadian equity market and the Canadian dollar, we have less conviction in, given that tug of war that I mentioned, and so we're closer to neutral there.
Interesting. Okay, I'm sorry, we're out of time. There was a lot to talk about. I would have loved to get through another 5 questions, but we've run out of time and they're going to yell at me. David Wolf, thanks for joining us and thanks for coming in. Appreciate that.
Thanks.